Hello, everyone. Welcome back to a new episode on financial literacy. For the new joiners, this is Mukesh Goswami, your host and coach. I'm running a series on financial freedom through financial literacy. Do subscribe to my channel if you believe that you need a boost in your financial confidence. Today, I'm going to talk about single family rental investment. And this is going to be a deeper insight into how to get prepared to make rental investment and possibly how to execute your first purchase. So let's get started. To set the agenda so that you know what I'm planning to cover today, my focus is going to be on properties that give you passive income, and the segment focus is residential rental, single family homes. I'll start with breaking some myths and misconceptions. I have been sharing my experiences, and this is purely from my perspective. So, this is not a one shoe fit all formula, but this is what has worked for my portfolio. So, I'll talk about what myths and misconceptions with smart investing I have kind of done through my investments. Secondly, I'll share some of my knowledge building till date, that what you really need to know before you make your first investment. It has to be an educated investment. Secondly, I'm going to talk about why it really makes sense from cash flow perspective, from equity growth perspective, what the whole fuss is all about. And then I'm going to talk about how do you evaluate a deal, both from the asset analysis perspective as well as cash flow analysis perspective. So by the end of this video, you should be feeling confident about whether you want to really make investment in real estate or not, and that too in residential rental. In a continuing series, I'm going to go and walk you step by step how to really do your first purchase, so that you can refer to this overall process as your kind of master checklist. So do subscribe to my channel. It's going to be really good source of information for your financial literacy as well as investment processes. So let's look into what kind of norms I have broken. So I leverage emotion. I leverage information or emotion. So this is my business. This is not something that I'm buying a home for my family to make memories. So I keep that aside. My primary home purchase is an altogether different ballgame, but this is buying a house for passive income. So I leverage information and keep aside the emotions. A lot of people feel that real estate investment is not a kind of remote investment. You need to have a feel, touch, and kind of be in person to execute. No, that's not what I have done. I'm a remote investor. I use online tools from the comfort of my home to make investments. And trust me, I have never visited any of my investment properties. Some of the cities are really the cities that I have only seen on maps. So I feel that personal visit and feel and touch, this is slightly overrated for a pure investment property point of view. Another factor a lot of people consider is that, oh, real estate, I have to be local. Yeah, that may make sense for some, but I believe your canvas is big. You can buy anywhere in United States. There are so many good markets. There are so many avenues to invest. You may or may not have the luxury of time to visit there personally. So my canvas itself is spread across 10 different states, and I'm doing it all remotely. Now, coming to how much money do you need? Well, it's real estate. You need some money, but you really don't need deep pockets. Look at my portfolio. The average buy price for my portfolio for a single family rental home has been about $135,000. So $135,000 is not really a big deal, particularly when you are leveraging mortgages. So, and with that kind of property, I do make an average monthly rent of 1325. That is $1,325. So, with an investment property valuing at 135,000, I'm able to collect a rent of $1,325, and my investment in this particular property is only 20% because 80% is being financed by the bank. So we'll go and look into deeper there. And lastly, I would say that while there are people who do a lot of due diligence analysis and all that, but and all that is good, but avoid analysis paralysis. Too much of analysis leads you to paralysis, and you may not be able to make a move. So, for an example, I spend less than an hour to evaluate a deal and make an offer. So, if you have right set of information, if you know what you need to analyze, you can do it quickly. So, uh, with my portfolio, I'm sharing that it doesn't really take more than an hour to evaluate a deal thoroughly and to make an offer. So, with that, let's jump right into the details. So, as a new investor, you might be confused about what to know, what you don't know, what basically are the kind of steps. So, here are some baby steps before you take the giant leap. So, before you make your first investment, it would be always wise and prudent to go through these basic steps. First of all, develop a habit of reading legal documents. I know a lot of people do not feel comfortable reading all the nuances in a legal document. But if you really want to be confident, if you really want to safeguard your interests, read and understand every single document yourself. And even if you engage professionals to do that job, I would advise you that you do not ignore the reading it yourself. Maybe you read it a couple of times and then you will get so comfortable that your reading will be very fast tracked because most of the documents are following a very similar template. So if you go through one set, once you purchase your first property and go through all set of documents, you probably will not invest that kind of reading time again and again in every single document. But again, it's very important to read through those legal documents. In this country, everything written is enforceable. Okay. So once you have developed that reading habit, I think the very first step should be obviously it makes sense for a passive cash flow to leverage mortgages. This country has a very streamlined mortgage industry, and there are very, very established norms and requirements how to get your mortgage. So I would suggest that go ahead and check your eligibility for mortgage. And there are so many nuances you should not just simply ignore because talk at length, get pre-qualified, talk at length that what kind of documentations are required. Prepare those documentation upfront. If you prepare all the documentation upfront and you get pre-qualified, it will be really helpful and it will save a lot of stress during the buying process. Uh, Another thing is that you need to have a down payment. And let's, for the sake of this presentation, let's consider that you should have a minimum 20% down payment handy. And that down payment is also having certain nuances associated that if you're buying a property with mortgage, then that down payment cannot just be, for example, it cannot be lended by your friend. So the mortgage companies put restrictions as to how do you source that down payment. So be very clear about that. Then get yourself comfortable, understand the buying process in details. There are very defined milestones, contingencies, a overall timeline, and what are the key responsibilities and tasks associated. So draw a mind map of what is the buying process, make yourself comfortable, and move forward. Now, most likely you have decided on buying a property. So if you have decided that you are going to buy a property, who is going to be the owner? So there are again too many nuances. You can be a single owner, you can be a joint owner with your spouse, with your partner, with somebody you trust, or you could uh, own that property in an entity where you have your own interest. So there are so many ways, and there are so many pros and cons, that who should own the title of the property, and you should be making that educated decision based on your learnings. And again, being a landlord is not so trivial. There are risks, there are obligations, there are hassles. Now, everything can be kind of mitigated, everything can be planned, but at least you need to be educated that what are the risk obligations associated of being a landlord, and you should be comfortable once you go through those. Now, this one important point. A lot of properties do come under HOA, Homeowners Association. And a lot of HOA are not very, very favorable for landlords. So you need to understand, if you are buying a property which is under HOA, then go through HOA covenants and figure it out that how does it impact to you as a landlord if you're buying that property. So with these baby steps, I think uh, you would be very, very confident, comfortable to move forward and start looking for the properties to invest. Now, moving forward, let's understand why it makes sense for a passive cash flow perspective. So your motive to buy a real estate single family home is mostly to generate passive cash flow. That is, you have a job, you have another source of income that depends primarily on you. But this source of income should be where you do not actively contribute on day-to-day basis. You do not basically invest time once it has been set up. So let's look at, and I'm going to take a sample scenario where the purchase price of the property is 150K. Oh, this might be shocking for a lot. What do you get for 150K? A lot. As I said, I'm spread out of 10 different states, and my portfolio, the average buy price is 150K. There is a lot that makes sense in that price range. So for a 150K property, bank provides 80% for 30 years time period. So there you are getting 120K from bank. You are investing 30K of yourself. Now, closing cost. There, there are a lot of closing costs associated. You pay to your mortgage company some fee, you pay to your attorneys, your closing agents, your escrow company, your county, city for recording and all that. So all those costs associated, a rough estimate, or I would not say rough estimate, a very good estimate is about $4,000 for a 150K property. Now, a lot of people may say that this is a percentage of your sale price. Probably not. It doesn't really attach as a percentage as long as your attachment of percentage is buying points from your mortgage. So that's a little nuance, but let's say for a 150K property, you should be good for a $4,000 closing cost. So your out of pocket investment, that is the money that comes right from your own bank account, is about $34,000. Now, with that $34,000, let's look at that's an investment you have made, and assume that you have bought the property. So after that, it's a business. What is the kind of expenses associated with that business? So in my sample scenario, uh, taking today the mortgage rate at 7% for a 30 years, I end up paying an interest and principal of about $800 per month. And that basically is kind of fixed. If I have taken a fixed loan, this is going to be fixed for next 30 years. Property tax slightly varies, but it all depends on your sell price of the property and the rules of that county and city. So typically for this price point, it will be about $1,500 if you are buying in the right market. So it's not across USA that you are getting $1,500 for this property, but I'm talking of those market where it makes really sense to invest. So $1,500 is your property tax. Insurance, if you are not buying in any unfavorable territory, your insurance should be about $750 for the year. That becomes your fixed expense, your mortgage, your property tax, your insurance. Then there are operating expenses when you put that property into a rental business. So you end up paying, just like me, I don't manage my properties myself. I hire professional property managers, and my cost is $70 per month for a particular, for any property, irrespective of whatever the rent value is. So $840 per annum is my property management. Repairs and maintenance. If you have done due diligence when buying the property, typically, if your property is in good shape, it should not consume a lot of repairs and maintenance. But if just for the normal wear and tear, just keep aside about $1,000 a year as a kitty for repairs and maintenance. You may, in some year, you may spend a little less. In some years, you may spend a little more. And some years may be so green that you don't spend at all. So overall, about you end up spending $11,850 annually for this rental investment property. Now, if you are putting it in rent, then you are drawing a rental income. My average rental income for this price point is $1,400 per month. That gives me $16,800 per annum. Now that makes my annual profit after deducting 11,850 as my expense. I get an annual profit of $3,110. And remember, this annual profit of $3,110 is on an investment of $34,000 only. So what is the annual yield you are getting? 9.15%. So by investing only $34,000 from your own pocket, you have got an income of 9.15% in your hand. And just for the context, most of the instruments, banks or governments give you somewhere like 4%, 5%, 6% kind of annual interest. So here, your annual interest is 9.15%. And now that you're making $3,110 as an income, you may be worried about, oh, Uncle Sam is going to take some part of it as tax. Probably not, because you are also getting tax benefit on an investment rental property by depreciating the cost of acquisition over a period of 27.5 years. So we'll talk about that later, but almost always this income could be completely tax exempted. Okay. So why it makes sense from equity growth perspective. So as we spoke about that you end up investing only $34,000 and you ended up buying a property worth $150,000. So let's be very, very pessimist and say that your property that you have bought is not going to appreciate at all. Today it is $150K. 30 years from today, it still remains $150K. And you keep on doing regular repairs, maintenance, and all that. So even if your property does not appreciate at all, think of it that you only invested $34,000, and at the end of 30 years, this property is still $150K and you have no more loan to pay. So that means your 34,000 has become $150K in 30 years, all the while you were still enjoying 9.15% annual yield. So that means your investment has grown 4.4x times without doing anything, and still it was giving you a yield of 9.15%. Now that's pessimist scenario. Let's be optimist. On an average, across USA, the home appreciation is roughly estimated at 10% in 3 years. So if it is not really a very, very bad investment, then you should be sure that your home is going to appreciate at least 10% in 3 years. And if we take that moderate appreciation, then your 150K property today will become 390K in 30 years. And if it becomes 390K in 30 years, then you only invested $34,000. So that 34,000 becomes 390K in 30 years. That means 11.5 times. So you have grown your money 11.5 times of your original amount. All the while, you are also enjoying a cash flow every month. So that's how it makes sense in rental real estate in USA to invest with mere $34,000 at any given point in time. So it may be tough to analyze a deal. Does it really make sense for me, this particular deal? So let's run a couple of points about how to assess a deal from asset analysis perspective. So you're buying a physical on the ground asset, and that asset at least should not depreciate. If it depreciates, wonderful. If it doesn't depreciate, I'm still safe. But if it depreciates, it probably is a bad investment. And real estate is known that it never depreciates, given the sufficient amount of time. I'm not saying that if you buy it today, it won't depreciate tomorrow. It can, but if your time period is 2+ years, you probably, and if you're not selling it in distress, you probably will never sell with depreciation. Anyway, so let's talk more. So your analysis should focus on whether it's an appreciating asset, whether it's a money pit, or whether it's a nightmare. Money pit could be that it needs so much of repairs, maintenance, and renovations that you end up investing money. So that's a bad deal. Nightmare could be that it's in a neighborhood, it's in a tenancy situation, which gives you a lot of hassles, which gives you a lot of problems with respect to keeping the compliance with the city code, county code, your HOA, your so many blah, blah, blah. So I think this is focused on how to evaluate a deal. So again, there are factors which are at the macro level, your state, your county, your city factors. Generally, there are some states which are landlord friendly, some states which are not so friendly to landlord and more friendly to tenant. So as a landlord, study about if in an unfortunate situation, if you have to evict your tenant, how easy, how difficult it could be to evict a tenant. What are the recourse? What are the guidelines about tenants who do not pay rent on time, or how to collect default rent? And what is your what's your rights, duties with respect to a bad tenant? So this is where you should make comfortable decision about which states are out of consideration for your investment. Secondly, a lot of counties, cities do enforce some kind of business licensing to run a rental property business. So if you have bought a property in a particular county or city limits and you are putting a tenant on that, you probably need to acquire business licensing. You need to do landlord registration, some compliances, some fee. It's not going to be too much, but every little penny adds. So there may be a little bit of nuances associated. So understand those before you basically commit to a deal. Then understand property taxes, the history of property taxes. So Your property tax is going to change based on your current buying price. So understand what is the tax in your city, in your county, in your state, and what kind of nuances are attached. So sometimes property tax may itself make your property unviable for investment. Okay, so make an informed decision on that. Then there are neighborhood factors. What kind of housing mix is there? If a particular neighborhood has too much of it's a mixed population with some single family homes, some multifamily homes. Most of it is uh, kind of rural, urban, or probably farmlands and all that. So it all kind of impacts your property. And what kind of schools you have in nearby, what kind of markets you have, what kind of job scenario in the vicinity is there. Is the population more of a stable resident population, or is it a migratory population? And just study the trends in that neighborhood, how the property has appreciated over last 1 year, 12 or 1 year, 2 years, 5 years kind of time period. What do you see as the kind of encouraging factors for this neighborhood in next few years? What has been the renting trend? So these are some of the things that you need to study about a particular neighborhood before you commit to the investment. And all this information you can find on internet. So there is nothing that you have to really go in that neighborhood personally to kind of collect. Well, it's good to always visit, but it's not required. Then there are insurance factors. Insurance, probably people ignore that. Oh, yeah, I know, and I understand that I will get insurance. But, you know, if a property has past insurance claims, if the property is in a fire zone, if it's in a floodplain, if it is in coastal area, your insurance cost could be too high to make it a viable investment property. So look into the history of insurance claims, or look into the zone that the property is in. Get a quote. There is no harm trying to get a quote from multiple insurance providers even before you buy the property, so that you know typically how much you are going to pay for the insurance. Then comes your specific property factors. The very first thing is, what is the actual age of the property? When was it first built? What kind of construction it has? And has it gone through any renovation, any major revamp? All that is considered. Then important factor is, even if you're buying slightly older property, look at when was the roof replaced. What is the actual age of the roof? It's a major cost, and you need to understand if you really need to invest in roof in next 2 years, 5 years, then what you are going to add more capex to it. Then comes a lot of kind of pockets where the money can go down in the pit is, understand the plumbing of the house, the electric of the house, the furnace, water heaters, appliances, HVAC, AC, everything. What is the age? When do you expect to kind of invest in that kind of that kind of category in this house? So this could be a costly capex investment, and every house typically, like depending on some of the appliances or some of the kind of setup, it may be 10 years, 15 years, 20 years that you need to invest money in these. So, and you cannot keep a property in kind of unlivable condition. So you need to keep investing. So analyze very, very closely that what investments you would need to make to keep your house in good conditions over next few years. Then understand the MLS history. So how many times this house has been listed on public portals for sale, for rent, and what has been the price and all kind of situations. Understand the rental history if available. Try to ask for if the property is actively rented out and there are active tenants. Try to figure out the rental history in your buying process. So all this is like, once you analyze this, you probably are making that the property is not going to be a money pit or not going to be a nightmare. it possibly is going to be an appreciating asset. So that's the asset analysis. Now let's look into cash flow analysis. How do you figure out that is this a property that will give you right cash on cash? Cash on cash is like you invested 34,000 from your pocket. What is the yield that you are getting on month to month basis, year to year basis? If you are even getting, let's say, by investing $3,400, if you are getting, say, $200 in your pocket every month, you are making a good deal because every month, just by putting $34,000, if you're getting $200, $300 in your pocket after meeting all the expenses, that's a great income. So some of the expenses that you need to really understand deeply is property tax. Some properties may have a county tax, a city tax, and it depends on your buying price. So understand, figure it out how much tax you are going to pay. Insurance costs, again, as I said, the premium could be exorbitant. Do not ignore. Just figure out a price, how much you're going to pay. Mortgage, principal and interest, how much you're going to pay. That all depends on what rate you negotiate with your lenders and all that. And if there is an HOA on the property, understand what is the monthly, quarterly, or annual HOA fee, and what are the other compliance that you need to agree to. So these are some of the fixed expenses that put down in your spreadsheet as expense. Then your operating expense. I use property management. You may want to do the property management all by yourself using online tools, maybe delegate it to some professionals. So you may end up paying either a fixed monthly cost or maybe a percentage of rent, whatever it is, just put down as an expense number in your spreadsheet. And then depending on whether you go for a yearly lease or a long-term lease, like 2 years or 3 years, there may be a cost associated with leasing and renewal. Typically, property managers may charge, uh, just for renewal, they may charge $100, maybe $150. For putting in new tenant, they may charge half of the month rent. Maybe some companies do a very fixed amount. So those are the numbers that you should put in your spreadsheet. Repairs and maintenance, you cannot predict everything, but I would suggest put a number down depending on what is your property's condition. Based on that, put a number down in your spreadsheet so that you can understand how much you are going to set aside for yearly repairs and maintenance. There are certain properties where some utilities are tied to landlord, or you end up paying those utilities, maybe water, sewer, maybe uh, kind of uh, trash and all that kind of thing. So if there are utilities that landlord pays, put down it in your spreadsheet. So once you have put every specific expense in as a number in your spreadsheet, put your current rent or a projected rent in the spreadsheet, calculate how much cash flow you are generating, then that cash flow on annual basis divided by your out of the pocket investment. And if you are making a good yield anywhere above 6% with an appreciating asset, that's a good deal. Annual 6% upwards is a good deal, even though today's mortgage price is quite high. But if you refinance in few years with the lower interest rate, you would be great. So overall, I have gone through the steps of how to evaluate a deal, what deal makes sense to you, what to kind of uh, go through before you make your first investment. Now, this is all a general preparedness to kind of start making your first investment. Now, that's all for today, but I will plan another video very shortly. And in that video, I will focus on that how, as an investor, I get to know these deals. It's an important thing. Zillow, Trulia, Redfin, these are not the only source. And these are not the great source for real estate passive investment opportunities. So there are methods and means where I get my investment ideas, and I will share those in my next video. How do I do the due diligence? How do I negotiate seller credit? Even after making an offer, I still bargain for seller credits. And how I navigate through the buying process. I'm going to talk in detail in my next video. There are certain red flags. Even if I have made an offer, I'm in contract, there are certain red flags that I can kind of analyze and exit out of that contract without losing my earnest money. So there are some tricks, tips, how to exit out of contract without losing your earnest money. Now, after you have closed, the property is yours. There are still some uh, amount of due diligence and work that you need to do. So first 30 days after closing, this is how I add a property to my portfolio, how I organize. I will share some tips and tricks with you. And then, most important, I'm a remote investor. I let my property managers manage the rental properties. I will share those nuances. How do I evaluate property managers? What are the kind of pros and cons? What kind of safeguards you need to keep in mind when you are letting somebody else manage your rental properties? So stay tuned for my upcoming video. This will be coming up very shortly. Do subscribe to my channel and put in your comments and suggestions if you want to touch upon any specific topics. For now, this is me, Mukesh Goswami, signing off, and very soon coming back again with a new video. Thank you. Bye.